Hello and morning, everyone. This is Shikhar bringing you Almus Market Mornings. And today's morning showed some sort of respite for Chinese tech investors as the tech shares rebounded from its brutal sell-off in the past couple of weeks. And we also saw some bit of move on the currency front as the whole markets await an update from FOMC on its monetary policies. So we have JK here today who will be updating us on that front. JK, please go ahead and tell us what should we expect out of FOMC and the markets correspondingly.
Thank you, Shikhar. So it's a pretty longish commentary today because so many events are lined up and so many things are happening. To start with, while everyone is focused on Ukraine conflict and possibly getting more optimistic on the outcome of ongoing peace talks, lots have been happening in Asian markets, particularly in China and Hong Kong. Equity markets in both fell a hefty 5% this week on a host of negative factors. Market disappointed by Chinese authorities not cutting policy rates, fresh problems in infrastructure sector, and more than all, another set of regulations from authorities for the tech sector, leading investors to dump stocks. Chinese currency has fallen more than 1% in the last 2 days, trading 6.41 from 6.30. A big surge in new COVID cases in certain regions, leading authorities to lock them down completely in line with their zero tolerance policy, was also another factor. There are reports of hefty selling of stocks by foreign investors and repatriation of dollars, even though the macro data on industrial production and retail sales come much better than expected. Chinese composite index is now near to entering a bearish territory if it falls another 3%. Coming to the US markets, optimism about peace talks and PPI inflation coming lower than expected, along with the hefty fall in crude prices, helped Dow rally by 2% and Nasdaq and S&P 500 posting 3% rally. Of course, Empire State Manufacturing Index dropped heavily, raising concerns that economic activity may be getting impacted already, which the central banks will take note. Data from Europe was not inspiring, with both industrial production and zoo economic sentiment data disappointing, which stunted initial euro rally about 1.10. UK data, on the other hand, was another set of good numbers on employment, keeping alive prospects of 0.25% rise in their policy rate, the third successive rate rise by BOE. On the money market side, US 2-year yields retraced from 2.5-year high at 1.89% to 1.84 before crucial FOMC meet. 10-year US Treasury is now dealing at 2.14%. Indian 10-year G-Sec yield drifted lower to 6.82%, tracking the fall in crude oil prices. Interestingly, 1-year annualized premiums in India has also fallen by 30 basis points to 3.92% in the last 2 sessions due to monetary policy divergence between US and India. In other developments, there is a potential sovereign default by Russia on external foreign debt for the first time since they have refused to service or recognize imperial Russian debts. Saudi Arabia also held out in what is currently seen as a threat to US policies that they would resort to yuan as a settlement currency for their export to China. A bit on the Fed meet, we expect them to deliver a 25 basis points hike without making any technical adjustments to the RRP or IOBR rate. Fed could signal as many as 6 rate hikes as against dot plot of December that indicated 3, likely to be followed by 4 in 2023 and possibly a terminal rate between 2.5 to 2.75%. Economic projections can be possibly showing higher inflation and lower growth. Press conference will, of course, be the venue for Powell to provide more details on the plans for reducing the size of the balance sheet. We expect Fed to eventually use their playbook with the monthly runoff caps of US Treasuries and mortgage-backed securities, which are likely to be 60 billion and 40 billion respectively. Coming to the INR, we had another swing to the upside yesterday, backed by big buying from oil companies. even as global Brent crude prices dropped heavily to trade a low of 97.44, which is a loss of about 30% from the peak. Initial gains on the back of oil falling were eroded with importer buying, and further weakness erupted after news of one of the key supply lines of gas from Russia to Europe was closed, raising renewed fears of energy prices surging. Local stocks also weakened after the initial rally, taking cues from global markets, especially China and Hong Kong, both of which fell heavily, as I already stated. However, FI flows have been modest in the last few days compared to the hefty numbers that we have been seeing of late. Mr. Shashanka Bide became the second member of RBI MPC after Mr. Jayant Rama Verma to voice concerns about elevated inflation. Market looks with a lot of interest on the outcome of RBI policy meeting next month. The rupee, of course, looks confined to the range of 76-77 for now, although we may see some volatility tomorrow depending on the outcome of Fed meeting. There is a sense that central bank is managing the currency volatility very effectively, ensuring stability even as the rest of the global financial markets remain turbulent. Even a fall of 1% in Chinese yuan and some other Asian currencies has not impacted the rupee, which seems to be well balanced in terms of demand and supply for the time being. Have a good day. Thank you.
All right, that was actually quite insightful, though a bit long, as JK mentioned. But guys, we need to see a few of the pointers that even though there was hefty correction in crude prices, yet it is not the only reason for inflation to go high. And like JK mentioned, the economic indicators for few of the locations or economies are not that inspiring. So let's see, but we do have a bold central bank to help us or manage the economy in this turbulent times. Let's see what it comes. Till then, goodbye, take care.